Alright guys, so like I've talked about in my videos, I've been in this trading game for over 20 years now, and let me tell you, I've seen my fair share of ups and downs. But you know what, through it all, there are some patterns that have stood the test of time for me. In this video, I'm spilling the beans on my absolute favorite patterns that I still trade week in and week out. So let's kick things off with my top trading pattern. The accumulation, markup, and distribution, also known as AMD. The reason I'm a fan of this straightforward and easy to understand pattern, which is obviously based on the Wyckoff market cycle phases, is because I think it helps you as a trader identify the stages of price movement in the market. Generally speaking, and as we take a look at this example here, the accumulation phase should be thought as the gathering phase. Wall Street's deep pocket, the so-called smart money, start buying the market when it is at a low price, but not many people notice. The price stays relatively flat because not many are selling, creating a base or a range like this one. This is where the big players quietly accumulate the long positions. And now on to the exciting part, the markup phase. As you can see from the chart, the price starts to rip higher as more traders notice the move and jump in. It's like a wave of buying that pushes the price higher. This is often the stage where the retail crowd goes into FOMO mode big time, and you start seeing the market surging in a series of higher highs and higher lows. As the market transitions into a distribution phase, things begin to slow down. This is when the big players who bought early start selling their positions to lock in profits. At the same time, there are still traders jumping in, but the selling pressure from the smart money starts to counterbalance the buying. It's during this phase that the market often moves sideways, creating a channel as supply and demand reach an equilibrium. It's precisely in this moment of equilibrium that you'll often see signs of market indecision, which in this case comes in the form of a doji bar. When the price finally breaks below the base of the channel following a reversal sequence, which tells us the market is in a reversal path, that's your cue to enter a short position. That's because this break indicates that the market is likely to attempt a rebalancing move, reaching to these imbalances that were obviously created during the markup phase. So here we can see the AMD pattern completed with the price significantly below support, indicating we are well within the accumulation phase. By the way, this sequence of imbalances can also serve as potential profit targets. The demand zone pattern is another great trading concept you can use. In the 4-hour scenario we are looking at, the market is uptrending initially, but as it pulls back, it feels this large imbalance zone, which obviously represents a strong demand area where buyers stepped in. Following these corrective moves, we witness the formation and subsequent break of a 4-hour consolidation area. Now, this breakout above the sideways zone triggers a strong bullish sequence initiated by this fast, impulsive move. This price action that clearly creates a lack of liquidity on one side of the market confirms the validity of the sideways base as a demand zone, indicating buyer dominance. Remember, without this spike or impulse move, there is no demand zone, just an area of consolidation. Now, once you have established your demand zone, you have options for when to enter a long position. Certainly, you could have entered at various points like here or here and made green. But ideally, the best entry, in my opinion, always would have been when the market retraces all the way back to the base again. This retracement provides a solid long entry opportunity, allowing you to target the previous highs on the left. In essence, while not obviously foolproof, like many aspects of trading, if you approach demand zones the right way, there is a clear potential to rake in with such a trade concept. And now let's talk about supply zones. Just like demand zones, supply zones are super handy for spotting high probability trades. In supply zones, prices swiftly drop from the base through an impulse move, fueled by intense selling pressure, where sellers far outweigh buyers. During this type of move, prices puke lower as selling dominates the market. At the same time, while there might be some short covering in the midst of this plunge, it's usually minor compared to the overwhelming selling pressure driven by a shorting frenzy as emotional traders chase the market downward. However, there comes a point where the last trader looking to short has entered the market, creating what I call a speed bump. At this level, even the slightest pause in price prompts a shift in sentiment, flipping the market to a bullish direction as retail selling pressure dissipates. After the market corrects its imbalances and retests the supply base, which is often the area where retail traders often capitulate, this is when smart money step in to short the heck out of the market and push it down again. So this upward retracement to the zone, a calculated move by smart money to again deceive traders into believing the market reversed and it is surging higher, presents a good opportunity, shorting opportunity that is, clearly with a stop loss placed above the supply zone. The redistribution descending channel pattern is another effective trading technique you can use across a multi-frame approach. Whenever this trade setup presents itself, I know chances of having a winning trade become really high. What we're seeing here is the market being in a pronounced downtrend, which is further intensified by a redistribution segment. Following this, an attempted upward move emerges down here, which initially appears to signal a trend reversal. However, the bullish momentum fails to sustain itself, resulting in the printing of a new lower low, thereby reaffirming through the formation of this descending channel what seemed to be a continuation of the bearish trend. However, this perception changed when the price action subsequently showed a strong bullish demand bar, effectively breaking through the upper trend line of this clear descending channel. And now this breakout signals possible change in market sentiment, challenging the previous assumption of a sustained downward trajectory. What further solidifies the effectiveness of the redistribution descending channel pattern is that once we convincingly surpass the channel's resistance level, the market's tendency toward a strong bullish sequence intensifies. Considering your entry options in this scenario, which I think is a good illustration of this pattern, you could have entered immediately on the breakout. However, I would have preferred waiting for the market to establish itself as it did, although in minimal terms, within this imbalance area before initiating a long position. Obviously, these previous highs on the left should be your profit targets. It's worth noting that for this pattern, it's not uncommon for the price to surge higher after breaking through the upper trend line of the channel without significant pullbacks. So to recap, the key element of this pattern include the redistribution segment, the manipulation up, and the impulsive push through the res level of the channel. Another trading pattern I really do like is what I refer to as the gasps of demand. You can learn more about this pattern in this next video. Alright gang, thanks for tuning in and as always, hope to catch you all in the next one.